Hey guys, Chris here from Blockchain Brothers, and today we're going to be looking at the importance of using risk to reward ratios when trading and also just psychology in general, because these are two major factors in trading successfully. So here I have open ETH and US dollar pair, and we will do what we'd usually do in trading is we'd draw our trend lines so we can have an idea of where we are headed, or possibly headed anyway. So I'd draw something like this. We'd also have something maybe, let's have a look, possibly like that. And just a few others to show where it's been. So that would have been a good one, because I want to show you the real importance of risk to reward here. So risk to reward is how much you're willing to risk in the hopes that you'd gain a good reward. So usually would use a 1 to 3 risk to reward ratio. You're prepared to lose 1, but you're hoping to gain 3. And obviously the higher the R number, the better your chance, or not better your chances, the better the reward would be. And this is so important because throughout trading, especially with the fake gurus and the scammers, you see this a lot, where they will be saying about the hit rate, how many times they've won. Look, I keep winning. Win, 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 win. One loss. Win, 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 win. One loss. But you need to look at how much they're winning compared to how much they're losing. This is where risk to reward comes in, because I can win £1 scalping 20 times. So I've made £20 profit. But that one loss that I get might be 50, £60. So actually I'm negative. And this is why hit rate doesn't really, like win rate doesn't really matter at all. Whereas if I was running a 1 to 3 risk to reward ratio, I could afford to lose 3 times and I'd be evens with my winning. I can lose 3 times and win once and I'll still be flat. So obviously if you find trades that I have like a 1 to 5, 1 to 10 risk to reward ratio, you can lose 9 times and win once, and you'll be up on those sorts of trades. Now, obviously, they're a lot harder to find, but it just gives you an idea of why you should be have it in you to find these good 1 to 3 risk to reward ratios. So that's what we're going to do now. As I was doing, we're just setting up these trends so we know where the sort of markets are going. We'll get rid of that. That would probably be about there, actually. And I know it looks very messy, but it's important to do this. Like, the reason I put this one in is just to show you an example of the risk to reward ratio. So if we go here, say you were following this trend line up, and you could clearly see it was on an uptrend. Even there, actually, you would, if you were following that, you would do something like this. Let's zoom into that one a little bit better, because that was the uptrend for that particular period of time. So you'd be going up here, and then you'd be noticing a sort of trend. You might have gone maybe there, would say there. You'd be noticing the trend is on an uptrend. So here, it didn't touch, but it sort of carries on up, and then we dink it here, and then we dink it here. So now you'd be thinking, right, we're definitely, because you're drawing this line now, we're definitely onto a sort of uptrend at least. So here would be a good entry. Let's just zoom right in so I can actually show you what we are doing. So you'd be now thinking, right, around about here is a good entry. So you'd put your 1 to 3 on. So what we'll do is we've got a risk to reward ratio of 3. Because I'm prepared to lose 1 in the hopes to gain 3. And because it's on an uptrend, you'd be looking for that. And this is exactly what you'd get. So this would be a swing trade. And if you put your money on here, your risk on, it would have gone up and it would have done this until it would hit your take profit. And that would have been a very good trade. But you would have had to have been patient for that trade. And that's why it's so important to set these parameters up, because we're emotional creatures, especially, like, we're very egotistical. We're so damn sure that we know exactly where the trade's going to go. It's definitely going up 100%. We all have that in us, and the truth of the matter is, nobody knows which way the markets are going to go. We have a good indication of where they're going to go, but I'm sure if you've been trading before, you can relate to this. You are 100%. I know for a fact that's going to keep going up, and you convince yourself. So you'll start projecting a bias, and when you start doing that in the markets, that's where you'll start screwing up. You've got to just take all your ego back. Everything's written in sand. You think it will go up, it looks like it's going to go up, but if it doesn't go up, then it hasn't gone the way you thought it was, which is why you set these stop losses, because you have to break the cycle of, okay, I was wrong, it didn't go that way, I thought it would, it didn't, we're out. And that's why you have to set these parameters, these stop losses, these trend lines, sorry. Also, it's always good to set your previous supports and your previous resistances. So again, you know sort of where you're going. You sort of know where the next sort of support should be. So for example, when we got in here, I'd be looking at this as a resistance because that's where we've had it before. But it broke that resistance, so now I'll be looking really good, and that would now become the support, which it did. It went up and then got down here, or near to it, and carried on up. For example, we might have then gone, right, that was a successful trade because we got out up here. Let's now move this trade to, because it's touched it again, although on this chart it looks like it busted right through, but say you put your trade there because you're going, right, well, it's hit it again, we're still on the uptrend, but then it breaks. Well, there's your stop loss, it's taken it. So that's when you would then reassess. You've taken your hit, but you've won at this point. You've won 3, and at this point you've lost 1. So you're still up 2. Do you see what I mean about it doesn't really matter about your win rate? What really matters is your risk to reward, and this is why it's so important. And this all goes along with psychology. This helps you, the 1 to 3 or the 1 to 4 or the 1 to 5s, 1 to 6s. It all helps you with your psychology because it sets the parameters for you. And you just need to if you're swing trading, for example, and you're someone who just has other work on and you're not going to spend all day looking at the charts. So this is a sort of swing trade because we're obviously on the daily. It takes a while to get there. So this suits people that have other stuff going on. They don't want to be looking at charts all day. So when you're swing trading, you just set your stop losses. Set your stop loss. Sometimes, I mean, I do set my take profits, but I also, if they're in a good position, I'll let them run because I will let my profits run, and I'll just be trailing the stop all the way up. But this is why it's so important to do things like this. So again, you would have lost out here. And then we would have got some sort of pullback here, and then we would have got another pullback here. So then we would have probably drawn this trend line because every 3 hits I like on a trend line, then it confirms to me that that's a trend. So there's the 3rd hit there, and I'd be looking at that and I'd be going, right, that looks like a good little play. Let's put it on. So we would have hit our take profit here. That would have been a very good trade. And we would have started drawing new trend lines. Let's go to trend. So we'd have started drawing something like this. It would have broken that. For me, I would have expected this to come back down here because it normally breaks a trend, comes back to kiss it, and then goes off in the opposite direction. But this one didn't. So again, I would have expected this to hit this one. It didn't. It busted back through the trend, and at this point, I'd be thinking that's a good trade. I would have put my money on here, my risk on, and again, you would have won again. It's very easy to read charts when you've got it all in front of you. It's all very well and good me saying, yes, I would have done it there and I would have done it there. The reason I do it is just to show people sort of how we trade, and just it's more about your risk management. You need to nail your risk management down. You've got to get used to being, and I really do mean this, you've got to get used to being able to take a loss. If you can't get used to taking a loss, there's nobody in the world that wins constantly. Sorry, there's nobody in the world that does that. You're always going to take a loss, and that's so key. It is so key to take that loss. If it doesn't do what you thought it was going to do, take the loss. This is why I like using trend lines, because you sort of know where you're going, and I like using supports and resistances with my trend lines. It's all off of price action. It helps you get in to a position like here. When it busted down there, I would be, because the trend line's strong and these candles didn't close, or the bodies didn't close outside of this trend line, I'd be definitely would have been expecting that to be a fake out. But I would then be putting my trades on there, and on this one would have lost it. That's just the reality of it, and it happens. And then when it come back down again, I would have done it again. And yeah, you would. To be fair, I would have lost out on that one as well. But this is what happens. This is why it's important. So, but out of the whole way up there, I would have won 3, 6, 9 times and lost 3 times. I'd have been up 6. That's how it goes. You're not going to win every single time. You need to take the losses and make sure the losses are less than the gains. It's as simple as that, but you'll be surprised at how many people will let their losses run, and that is where you'll get into dodgy territory, and that is where you'll be a sandbag for things. You'll be holding on to things for sometimes, honestly, a year maybe, if it just keeps going down. Just follow the price action and really get used to being able to let go of money. That's so key in trading, and it's all about trial and error. You just learn new things. You see little tips. You see little tricks, and you can just do this with any charts. I mean, here's a nice double bottom. You would have got the neckline break there, and then we've got a nice pull up there. So you just use a lot of things in conjunction with each other. It's a good way of analysing the charts, and if your risk management is on key, your psychology is on key, and you're just following what the charts are showing you, hopefully you should get a good return. Like here, that looks to me like a good buy, to be honest with you. I'd put that buy, and I'd probably let that run up to about here. I wouldn't put a take profit on that, but I'd always have my stop loss, because in fairness, this is attacking, it's smothering this trend line here, and when a trend line gets smothered, it does break through normally. So, but I would have put I would have put my money on this and risked 1 for 3, or potentially risked 1 for. Let's have a look. I mean, that would be a good 1 to 4 play, I'd say. So yeah, that's how I would have. That's how I trade, and like I said, you just get used to taking the losses when you need to, because it's key. Taking a loss is key, and let your winners run. That's also really key. Anyway, guys, I really hope this helped. Please feel free to like, subscribe, comment. click the notification bell for more updates, and I'll see you on the next one.